Stop what you are doing right now. Before you open your portfolio, before you feel good about your gains this year, you need to hear this. Bank of America just published a report. And the title of that report is not something you hear every day. They called it, "The Door to Doom is Opened." One of the biggest banks in the world wrote that, and they sent it to their biggest clients, not to regular people like you and me. But today, you are going to hear exactly what it says. This report points to a specific line, a measurable historical line that markets have crossed before. And every single time it has been crossed, a major crash followed. Japan in 1989, the dot-com bubble in 1999, the housing crash in 2007. Same pattern, same signal, same result. And right now that signal is flashing again. Most everyday investors have no idea this is happening. That changes right now. The research in this report is the kind of thing big institutions pay a lot of money to get, but the message is similar. And, please if you break it down, Wall Street often keeps these signals quiet because it gives them an advantage. Now let's talk about the first warning. Bank of America calls it the Maginot Line. After World War I, France built a massive wall of concrete and steel. They called it the Maginot Line. The French military believed nothing could break through it. It was supposed to be the final defense. And for years it worked. Until one day, it didn't. Bank of America uses that same name for what just happened in the US bond market, specifically with the 30-year Treasury yield. That yield has now crossed above 5% for the first time in a very long time. When you lend money to the US government for 30 years, they pay you interest. That interest rate is the yield. For the last 2 decades, that number stayed below 5%. That ceiling was the wall. That was the Maginot Line. A lot of the financial world, stocks, real estate and loans, was built on the idea that long-term borrowing costs would stay L. And manageable. The moment that yield crosses 5%, something important has shifted. It means powerful money managers now demand a higher return just to lend to the US government. That is not routine. That is a warning. The bond market is the biggest financial market in the world. It is bigger than the stock market. And right now, that market is sending a signal that many people ignore. Bank of America studied past bubbles. Japan in 1989, the dot-com crash of 2000, the housing collapse of 2007. In every single case, the same thing happened. Long-term government borrowing costs spiked to levels that could not last. And when they did, the boom ended. Not slowly, it ended violently. Bank of America says the dam is now cracked. The Maginot Line has been crossed. Now let's talk about the second warning. Bank of America calls it the 4% inflation rule. This rule is not a guess. It is not a theory. It is built on 100 years of real market data. Here is the rule in simple terms. When consumer price inflation rises above 4%, stock markets drop an average of 4% in the next 3 months. Then they drop another 7% in the 7 months after that. Those numbers may sound small at first, but they are averages. They include mild cases where inflation touched 4% and then quickly cooled. We are not in a mild case right now. Consumer prices are rising close to 4% a year. But the bigger danger is producer prices. Producer prices are the costs manufacturers pay to make products. Those are rising around 6%. Producer prices usually lead consumer prices. It takes time for higher costs to move through the supply chain. Later, those costs show up in the prices you pay. So the inflation you see now may not be the final number. It can be the early number. And when inflation stays high or goes higher, the Federal Reserve has to respond. The Fed's main job is to control inflation. If inflation does not come down, the Fed raises interest rates. Higher rates make mortgages more expensive. And car loans cost more. Business loans cost more. Credit card debt costs more. When borrowing costs more, people spend less. Businesses invest less. Company profits shrink. And when profits shrink, stock prices usually fall. At the same time, energy costs can rise. Shipping costs can rise. Rent can rise. The average person already stretched gets stretched even more. Bank of America projects inflation could reach 5% in this cycle. That is a serious call. And if it happens, markets will feel it. Now we get to the third warning. Bank of America calls it the Alligator Jaws. Picture an alligator with its mouth wide open. The top jaw is the stock market. It has been hitting record highs. It makes people feel safe and smart. The bottom jaw is the bond market. It has been weakening. It has been sending stress signals. The gap between these two jaws is now the widest ever recorded. And here is the hard truth. Alligator jaws always close. When related markets move far apart like this, they all and ways come back together. The only question is how. Either bonds recover strongly or stocks fall to meet the bond market. A bond recovery would require inflation to drop fast, the Fed to turn friendly, and global confidence to surge. It is possible in theory, but unlikely in reality. The other outcome is stocks falling, and that is what has happened in history when this kind of gap shows up. There is another risk too. Bank of America says about 72% of the S&P 500 rally this year has come from only 10 stocks. 10 out of 500. The rest did almost nothing. And many of those top drivers are in tech, especially semiconductors and artificial intelligence. The chip sector is trading around 60% above its 200-day moving average. Think of a rubber band. The 200-day moving average is the normal resting point. When you stretch a rubber band far past normal, it does not stay there. It snaps back, and the more it stretches, the harder it snaps. Bank of America compares the current chip surge to external and remember bubbles from the past, including the dot-com era. And history shows what can happen when a concentrated boom breaks. Japan is a painful example. Their market fell hard and took decades to fully recover. Bank of America says parts of today's warning signs look structurally similar. History does not repeat perfectly every time, but it often rhymes. And right now, the rhyme is loud. Now I want to shift from fear to strategy, because a warning is useless if you do not know what to do next. Big market drops are painful, but they also create the best buying chances you may ever see. And that is not a fantasy. It has happened again and again. After almost every major crash in the last 100 years, a small group of prepared investors made life-changing money in the next 1 to 2 years. Not because they guessed perfectly. They won because they had a simple system. They had a plan before the panic started. Look at 2020. Prices fell fast. Fear was everywhere. But after the bottom, some stow, and CKs exploded upward. Freeport-McMoRan went from about $5 to over $50 in less than 2 years. Royal Caribbean climbed many times from its low. Zoom surged too. These moves were not magic. They were the natural result of panic selling, followed by recovery buying. The goal is not to predict the next headline. The goal is to be ready for the moment when strong companies get thrown away at cheap prices. So here is a 4-part framework to spot those chances when the next major drop hits. Step 1 is deep value recovery. When markets crash, selling is not calm and logical. Computers sell. Funds sell to meet margin calls. Regular people sell because they are scared. In panic, the market does not carefully separate good companies from bad companies. It dumps many stocks together. That is where opportunity is born. In a crash, you can sometimes buy a strong company at a price that makes it look dead, even when the business is still solid. You look for stocks down huge amounts, like 70% or more, and from their all-time highs, while the company still has real sales, real assets, and enough strength to survive. There is a big difference between a company that is broken and a company that is just hated for a short time. In 2020, Freeport-McMoRan was not worthless. It was still a major copper producer, but it got priced like it would not make it. When fear faded, the price snapped back. That snapback is where big gains come from. Step 2 is secular tailwinds. This separates a normal rebound from a massive winner. A secular tailwind is a strong trend that can last for years. It keeps moving forward even when the economy has short-term problems. Think about trends like digital tools growing, online shopping expanding, more healthcare needs as people age, rebuilding roads and power systems, and the move toward electric cars and clean energy. In 2020, some companies did not just recover, they flew past old highs. Why? Because they were cheap and they had a powerful trend behind them. And Zoom benefited from remote work. Shopify benefited from online shopping. Those trends existed before 2020. The crisis just sped them up. You do not want just a cheap stock. You want a cheap stock with a strong tailwind. Step 3 is the too big to fail filter. This is not about politics. It is about math and survival. In modern economies, governments usually do not let certain key industries collapse fully. They step in when the damage would be too big. In 2008, the government supported major banks because letting the banking system fall apart would crush the economy. Later, those banks produced strong returns for investors who bought during the panic. In 2020, parts of the travel industry got support too because the system around it mattered. The point is simple. Some industries have an invisible safety net. That lowers the chance a company goes to zero in a crisis. So pay attention to sectors that are critical to daily life and national function. Big financial firms, key infrastructure and structure, defense, important energy and materials, important supply chains. This can improve your risk compared to random companies with no help coming. Step 4 is the commodity cycle. Most regular investors ignore this, which is one reason it keeps working. When a recovery begins after a crash, the real economy needs raw materials first. You cannot rebuild without basics. Copper for power grids and wiring, oil and fuel to move goods, steel for construction, lithium and other materials for batteries and energy storage. Commodity producers often get crushed during the crash because investors assume demand will stay weak. But when recovery starts, demand can jump quickly. If supply cannot rise fast enough, prices can rise sharply. That can lift profits for the companies that produce those materials. This is not hype, it is supply and demand. Freeport-McMoRan ran fits again because copper demand rises when building returns. Some oil producers also had massive rebounds after 2020, these patents. And turns repeat because the real economy runs on materials. Now put these 4 steps together. Deep value recovery, a long-term tailwind, a too-big-to-fail layer of safety, and smart positioning for the commodity cycle. When you find a stock or a sector that matches all 4, you are stacking the odds in your favor. You are looking for the kind of setup that has created huge wealth-building moments after past crashes. You do not need perfect timing to use this. You need preparation, patience, and the ability to act when fear is loud and prices are low. Now let's get practical. Knowing risk is rising does not help unless you know what to do with your money. A market drop can feel like a disaster, but it can also become the best buying chance of your life. The difference is simple. Are you prepared before the panic starts, or are you reacting after it is already too late? Here is what you should do starting now, this week, while the market is still high and your mind is still calm. And Saturday, build a watch list, not a shopping list. You are not rushing to buy today. You are choosing what you would want to buy later if prices fall hard. Write down strong companies and strong sectors you would be happy to own if they became cheap. Pick names you understand. Pick businesses that can survive a storm. Then set target prices now. Decide what price would make you say, this is a deal. If you wait until fear is everywhere, you will not think clearly. In a crash, your brain will scream, don't buy anything. That is why the list must be made ahead of time. Second, decide how you will use cash. Cash is not exciting. Over time, inflation eats it. But cash has one job during a crash. It gives you power. It lets you buy when other people are forced to sell. It lets you move fast when prices fall to your target levels. You do not need to go all cash, but you should think about having a real reserve, not for comfort, for action. The goal is to be a buyer at low prices, not a trapped. And seller. Third, make rules before emotions take over. Emotions are expensive. Fear makes you sell at the worst time. Greed makes you buy at the top. Pride makes you hold a losing stock because you do not want to admit you were wrong. So you need rules that run your decisions, not your feelings. Decide in advance what will make you buy. Decide in advance what will make you take profit. Decide in advance what will make you cut a loss. Use clear numbers. If a stock hits your buy price, you buy a small amount. If it drops more, you can add a little more. If it rises to a level where it is clearly overpriced again, you take some profit. If the business changes in a bad way, you exit. The exact rules can be simple. The key is that they exist before the chaos. Now pay attention to the calendar. Markets also move because of events. Meetings, announcements, decisions. Oil producers meet and talk about supply, and that can shift energy prices. Global leaders meet and talk about trade and supply, and why chains, and that can change costs for businesses. And the biggest one is the next Federal Reserve rate decision. A lot of investors keep hoping for rate cuts. They want cheaper money again. But if inflation stays high, the The Fed cannot cut just because people want it. If the Fed signals that rates will stay high or could even rise, the market can react fast. When stocks are priced for good news, even neutral news can feel like bad news, and the move down can be sharp, so the window for getting ready is not someday. It can be measured in weeks. The people who lose money in crashes are not always foolish. Many are smart. Many have been investing for years. They lose because they are not ready. They ignore warning signs. They tell themselves, this time is different. They treat rising prices like proof nothing can go wrong. They confuse paper gains with real safety. The people who build wealth during crashes are not superheroes. They are prepared. They made their watch list early. They kept some cash ready. They wrote rules and followed them. And when everyone else was panicking, they acted with discipline. Bank of America used a dramatic phrase for a reason. They said the door to doom is open. That does not mean a crash must happen tomorrow. It means risk is rising, and the signals are lining up in a way that has ended badly before. You can ignore it, or you can use it. You can prepare now, so you can buy strong assets later at low prices. Or you can keep celebrating a rally right up until it turns into a trap. Make your watch list. Set your target prices. Hold a smart cash reserve. Create rules. Watch the key dates. And when fear shows up, do not freeze. Execute the plan you already built.